Hi everyone, Jeff Yasteen here. Make sure to subscribe to our YouTube channel. Follow me on Twitter at Jeff Yasteen and on Facebook, Jeff Yasteen1. So make sure also to share this video with friends and colleagues as well. Let's spread the news. So on August 4th, I posted this video, which predicted that the stock market rally would end by Labor Day. And I encourage you to watch the video. Mainly, I did it based on an observation that I'd made that we saw a similar occurrence to what happened in the year 2000. That was when the dot-com bubble ended. The stock market fell hard in March. The NASDAQ fell 40%, rallied through the summer, and the real sell-off didn't begin until after Labor Day weekend, when a lot of people were set up thinking that we would go on to yet new highs. So in my opinion, I think that's what we're looking at now, the opening phase of a correction, perhaps a steep one, that will take several months or longer to play out. Now, as you know, a half dozen or so tech stocks led the rally higher, and as a result, they now make up the majority, those stocks make up the majority of the market cap of both the S&P and the NASDAQ. So I think from here, we'll see a case of sort of the tail wagging the dog, money flowing out of tech stocks, more at some times, less at others, and into other positions like energy, financials, perhaps travel and leisure, industrial stocks, sectors which did not participate, or not very much, in the huge rally that we've seen in the broader markets, again, thanks to a handful of tech stocks over the last 5 or 6 months. Now, if you're heavily into tech stocks still, you do have other opportunities ahead to sell. We can see that by looking at the NASDAQ 100 chart. And this is a look at it here. This is the NASDAQ 100, the 100 largest stocks within the NASDAQ exchange. And we had the bottom of the beginning of the rally, if you will, the bottom of the pandemic sell-off in late March. And you can see all the way straight up basically through the middle of last week, September 2nd. And of course, we've had this sell-off since then, the last 3 trading sessions. The key here, 2 things I would keep in mind, because I think we're going to get a snapback rally soon within the next day or two. And one is these sort of purple pink lines here, that's defining what we call Fibonacci ratios. There's nothing predictive or magical about it. It's basically just a way to calculate certain percentages that are found commonly throughout nature, various mathematical ratios, Fibonacci ratios. You can read more about it elsewhere on the internet. The key here is, though, I use them to just help me to look for where pullback points are. And I find it very interesting that you have this blue line, which is the 50-day moving average. And it too is right there below where we're trading at right now, late on the Tuesday session. So what I'm looking for from here is perhaps a small penetration below this point, and that should be enough to bring about a fair amount of worry from investors regarding the overall marketplace. And from there, we should be able to get some sort of a snapback rally going. Much depends on investor sentiment, how we feel about the market, and whether investors become fearful enough to get a strong rally start. And I think we're close to it. And that rally will afford you an opportunity to still take profits, lighten up your risk. And word of caution here, snapback rallies are awesome to behold. Some of the largest one-day percentage gains ever in the history of the stock market happened during the biggest bear markets of the last 100 years. Snapback rallies will be so strong they'll make you want to get super bullish again. So I say that as a word of warning to not drink the Kool-Aid. Think of those rallies as a chance to lighten up on your exposure to tech stocks, presuming you have a lot, which most people do these days. Now, over the last 5 weeks or so, I've laid out some sectors and individual stocks I like: travel, energy, banking, insurance, airlines, real estate, investment trusts. More than anything, though, you do not have to stay 100% invested in stocks all the time unless you really want to just trade in and out of the market. Let your cash build up on the sidelines. There's nothing wrong with that. Wall Street fund managers have to keep their account holders' funds fully invested, for mutual funds, that sort of thing. Only rarely do fund managers go to cash in a large way. They don't get paid to be in cash. They get paid to invest your money. And from my observation over many decades, they are usually heavily in cash at the moments when really they ought to be buying instead of sitting on the sidelines. But it's just human nature the way these things work out. The point is, we're not at that moment right now. Unlike a Wall Street fund manager with billions of dollars at stake and an investment committee looking over your shoulder, your only investment committee is a committee of one, you. Or in my household, it's an investment committee of two, my wife and I. The point is, you do not need to go out and immediately invest your money into something else. And I speak from experience on this. There's nothing wrong at all with moving to the sidelines now when there's still a great deal of hope among many investors that the current weakness we've seen over the last couple of days is only temporary and it's onward and upward from there. It's amazing how cheap, though, stocks can get when you have patience and you get to that point where most investors lose hope and we see panic selling. If you want an example of panic selling, just punch up the chart of your favorite stock from last February and March. That is panic selling. Or when you see the usual group of talking heads on CNBC saying more or less across the board, I'm not sure, I don't know, I can't believe, it's too risky. At moments like that, the hard part is there's so much panic in the air, sometimes it's hard to sniff the opportunities as well. And again, sometimes it takes time for them to come up to the open. My instinct is we're not yet at that moment. It just depends on how far and how fast the stock indexes drop. Corrections tend to be very dramatic and they happen, quickly. Bear markets, and I hope I'm wrong about this, but bear markets are more of a process, like the ocean eroding the soil away at the bottom of a cliff. In a bear market, it takes weeks or months of this before investors' confidence is fully eroded and the cliff, so to speak, becomes unstable and falls apart. Now, I don't use that language to sound ominous and scary, to scare you. I think of it more just in terms of opportunity. And that's when it's nice to have a chunk of cash. If you want a good example, watch the first half of my recent video about Apple, overvalued and ready to sell, that we posted on the Wealth Press YouTube channel last week, just before the sell-off began. It's amazing how cheap a great stock can get, as Apple did in the last days of 2018, the first days of 2019, and in those moments when panic selling really takes its biggest toll. So we all have to take risks when we invest or speculate in the stock market. Not every recommendation nor every trade works out, but by minimizing our risks and focusing on the very best opportunities with the potential for strong upside gains, the rest tends to take care of itself if we're patient and we use good judgment on maximizing our opportunities and minimizing those risks. If you like what I'm talking about, make sure to subscribe on YouTube, follow me on Twitter and on Facebook. I'm Jeff Yasteen.